Global Finance, Topic 6, the identification, measurement, and mitigation of translation and transaction exposure. In this topic, we're going to learn about the types of FX exposure, translation, transaction, and competitive exposure. We're going to talk about the accounting FX translation methods and choice of functional currency. We'll talk about methods for managing translation and transaction exposure. We'll talk about the risk identification, measurement, and mitigation approach. And then we'll finish up with the identification, measure, and mitigation of translation and transaction exposure for Zapata auto parts. So, when we talk about foreign exchange exposure, there are three things we talk about: translation, transaction, and competitive. Translation exposure, you can think of this as simply accounting gains and losses that have to be reported in the financial statement due to changes in exchange rates. So for example, you have an accounts receivable in euro. It doesn't come due for an entire year, but as the financial statements are published, the exchange rate goes up or down. And the question is, do you have to show a gain or loss in the financial statement? That is the topic of translation. Now, transaction exposure is very close, except for it actually has a cash flow impact in the firm. So for example, you have a Chinese yuan payable for your outsourced production in China. When it comes due to actually pay the bill, the yuan appreciates and you actually pay more US dollars. So that's an example of an actual transaction gain or loss. And lastly, a topic we're going to talk about in a future podcast is competitive exposure. It's really long-term cash flow exposures that affect the viability of the business. So for example, you open a plant or a production facility in India or China. That currency appreciates and there's also inflation in wages, and now it's no longer competitive. So we'll talk about that long-term competitive exposure in a future topic. When we go through these topics, I'm always going to do exposure netting across currencies. So for example, you have a US-based multinational firm that has 100 million receivables, 70 million payables. So if we take our 100 receivables minus our 70 payable, what we'd say is this firm is a net receiver of 30 million euros. And if they're a receiver of euros, they're exposed to a depreciation of the euro, which will cause less dollars. So what we say, this firm is long 30 million euros. Long just meaning a firm that when it has a long position is exposed to a devaluation or a reduction in a price. However, what if they had $50 million of receivables and 70 million of payables? Well, in this case, they're a net payer of 20 million euros. So in that case, they're actually exposure, since they're a net payer of the euro, they're exposed to an appreciation of the euro, meaning it'll cost more euros to pay off this payable. So in this case, we say this company is short the euro. They have a net liability position. So now we're going to talk about something called translation exposure, which tells you which accounts on the balance sheet need to be revalued due to changes in exchange rate. So we'll start with this Zapata auto parts example. So this is a Mexican affiliate of a US multinational firm. And these are the accounts for this Mexican sub in peso. We'll forget about the millions for now. We'll just say they have 1,000 pesos in cash, 50,000 pesos receivable, 32,000 pesos inventory, and then we have these net fixed assets, which would be my property, plant, and equipment. We have 47,000 pesos of accounts payable, 12,000 pesos of long-term debt for a total liability of 59,000 pesos, the equity position of 135,000 pesos. My liability and equity is 194. So there we have our basic accounting identity: assets equal liability and equity. Now at the time, let's say on January 1st, the exchange rate is 12 pesos per dollar. 12 pesos per dollar. Whoops. So in this case, this is going to be reported in the financial statements, converting, say, all these accounts at, say, the peso per dollar exchange rate. Now the question is, if the exchange rate goes from 12 to 13, which is a devaluation of the peso, which of these accounts need to be revalued? And if there is a loss in value, does it have to report it in the income statement? So to do that, we need to talk about a translation method. A translation method is simply a method that tells you which accounts get revalued and which accounts remain on the books at the FX rate that was used when it was recorded. So there's 4 methods I'll talk about. 2 are used in the US. The first method is the current rate method. Now the current rate method says revalue all assets, all liabilities. So their net position for the firm, if you use the current rate method, is I take all assets minus all liabilities and revalue everything. So in other words, the firm's net position is all of equity, assets minus liability. So for Zapata, their assets are 194, their liabilities are 59. So I take assets minus liability, I have equity of 135. So in that case, we'd say that firm is net receiver or net asset position of pesos. They're exposed to a devaluation of the peso. The next method, which can be confusing with the first method, is the current non-current. So the first method, current rate method, says revalue all accounts, all assets, all liabilities at the current exchange rate every period. The current non-current method says only revalue the current accounts. So in other words, you think about what are current accounts. They're anything that's not long-term. So that'd be, say, cash, receivables, inventory, accounts payable. So these are my cash, accounts receivable, inventory, and accounts payable. Those would be considered short-term assets and liabilities. So in that case, the firm has a net asset position of 136,000 pesos. So in this case, again, the firm is exposed to a devaluation of the currency because only these accounts get revalued. Well, here's a third method, the monetary non-monetary method. In this method, the only accounts that get revalued are the accounts that reflect a sum of cash. In other words, they don't reflect a real asset like inventory or property, plant, and equipment. So let's think about the things that are simply a sum of money. This 1,000 pesos is a sum of money. This 50,000 pesos for accounts receivable reflects a sum of money. Inventory does not. Inventory reflects, say, widgets. Net fixed assets, that is not a monetary account. It reflects property, plant, and equipment. Accounts payable, that is a monetary liability. It's just a payable account in pesos. Long-term debt, that is also a monetary account, right? It's just a sum of money. So in that case, if I take my cash and receivables and my payables and my debt, they're a net payer of 8,000 pesos. So in this case, they're actually exposed to an appreciation of the peso since they're a net payer, meaning that if I just revalued these accounts and the peso increased, I'd have to show a loss. And lastly is the temporal method, which is very close to the monetary method. It just adds inventory. So the idea with the temporal method is the monetary, non-monetary methods makes a lot of sense. However, inventory is not held simply to hold the asset. It's held simply to turn it into cash. So therefore, let's just take the monetary assets and liabilities, add inventory, and we'll call that the sum of the accounts, or the net position needs to be revalued. So in this case, the firm is net long 24,000 pesos. They are exposed to a devaluation of the peso. So let's talk about what method actually gets used. In the end, what method gets used is either the temporal or the current rate method. So in the US, we're not going to use these two methods. We're going to use the current rate method or the temporal method. FASB 52 tells us what we need to do. FASB 52 says every firm for all its subsidiaries has to designate a functional currency. So for example, if Zapata is a Mexican subsidiary of a US multinational firm, so the US firm needs to either specify that the dollar or the peso is the functional currency. So they could say the peso is the functional currency or the US dollar is the functional currency. And if they say the dollar is the functional currency, FASB 52 says use the temporal method, which is monetary assets minus monetary liabilities and inventory. and you revalue all those accounts, and any gains or loss go straight to the income statement. So it can create some volatile earnings in the income statement. If they specify the peso as the functional currency, use the current rate method, revalue every asset, every liability, every time. But all gains and losses go straight to the balance sheet. Now, firms have an incentive not to show volatility in earnings that affect things like net income and earnings per share. So there is a bias that I'd rather show any gains or losses in the balance sheet so it doesn't hit the income statement. Now, I'll mention at this point a little caveat is if an account like accounts receivable has, say, you're going to receive pesos, that's going to be included in the net asset position. And if the peso devalues, there's going to be a loss in the balance sheet, an adjustment to equity in the balance sheet. Now, when it actually will hit the income statement is when it actually comes due. So in other words, when the actual payment is made and you receive the home company receives the pesos and then has to sell them, that's when it'll work its way to the income statement. So here's a little example of a choice of either if they use the dollar or the peso as the functional currency. If the company uses Zapata here, right here's Zapata's balance sheet. If they use the US dollar as the functional, they're going to use the temporal method, which means they're going to revalue all monetary assets and all monetary liabilities and inventory. So in other words, again, at the beginning of the period, the exchange rate was 12 pesos per dollar. So let's just assume all these accounts were put on at 12 pesos per dollar. Let's get their net position in these temporal assets and liabilities. We got cash, we got receivables, we got inventory, so minus my payables, minus my long-term debt. Their net receiving position, or net asset position, is receiving 24,000 pesos. So that would be the risk, or that's the net position they'd have to revalue. Now let's skip down here. If they do choose the dollar as the functional, and the exchange rate goes from 12 to 13, that is a depreciation of the peso. Since they're a net receiver, they're going to show a loss. Let me show you an easy way to calculate the gain or loss using for translation gains or losses. Let me just change colors here. The basic way of calculating a gain or a loss on an FX position is you take the value in foreign currency, the value of the FX, in this case 24,000 pesos, times the new minus old exchange rate, where you make sure that you put them in dollar per FX terms, in other words, direct quotes. So if I take my 24,000 pesos and the exchange rate goes from 12 to 13, in other words, the dollar price went from 1/12 to 1/13, that's going to show a $154 million loss, which will go directly to the income statement. Now, if they chose the peso as the functional, and this is not something you would change every period, they might reevaluate it every decade or so, but if they chose the functional as the peso as the functional currency, there's a, in your financials, you need to submit for every subsidiary what is the functional currency. They would use the current rate method. In other words, all assets and all liabilities get revalued, so their net position is all of equity. So if the peso is the functional, my V is all of equity, assets minus liabilities. So I take my equity position, 135,000 pesos, times the change in the exchange rate, and I'd have to show an $865 change that goes directly to the balance sheet, bypasses the income statement until those accounts actually come due. So that's translation exposure. Now let's talk about how a firm would manage any exposure, really, but specifically FX exposure. One method in risk management is called the IMM method. The way to think about risk is you first identify your risk. What are you exposed to? You then measure it. What is the size of the risk? And then lastly, you mitigate it. In other words, you decide either to accept the risk or to hedge it or get rid of it somehow. So for our positions, we're going to first identify our translation exposure. We're going to then measure it, and then we're going to decide how to mitigate it. So risk identification for Zapata, whether they use the dollar or the peso as the functional, right? We determined that their net position is they're long pesos no matter what they do. So their exposure is going to be they're going to be exposed. The risk is to it for a devaluation of the peso. That is their risk. Now the question is, well, how big is that risk? Well, one thing you can do is just look at your position. They're either long 24,000 if the peso is the functional, or they're long 135,000. I'm sorry, if the dollar is the functional. All right, so they're long 24,000 pesos if the dollar is the functional, and $135,000 if the peso is the functional. All right, so you know your positions. Now the two common ways of measuring how many dollars you could lose would be, say, a simple stress test. Say, how much would I gain or lose for a 10% change in the exchange rate? Or we do an earnings at risk number. So let's do a simple stress test. Let's say that how much would I gain or lose if there's a 10% change in the exchange rate? So in this case, we're exposed to a devaluation of the peso. So what I can do is to say if the exchange rate is currently 1/12, a devaluation of 10% would be 1/12 times 0.9, which is 0.075. Which, by the way, if I do 1 over 0.075, that's really the exchange rate going from 12 to 13.33. So a 10% devaluation of the peso is the exchange rate going from 12 to 13.33. So how much would the firm lose if there's a 10% change in the exchange rate? I take my V times my new minus old exchange rate. So a 10% change would be going from 12 to 13. They'd have a $200 exposure, $200 loss if there's a 10% depreciation of the peso. Now the only thing the nice thing about this measure is you can just maybe have a 1% change or a 5% change stress test, but you don't really know what that means. Like, how likely is it for a 10% change in the exchange rate? So for that reason, probably the more popular measure of how much I could lose would be an earnings at risk number, EAR. So an earnings at risk number, the formula is going to be my V, which is my foreign currency, times the standard deviation of the currency in dollars. So say dollar per peso, times Z. Now Z is going to be a value which is based on the confidence interval of this EAR. So it'll either be a 95% confidence EAR, which means the Z takes on the value of 1.65, and that comes from a standard statistic for normal distributions. Or if it's a 99% confidence interval EAR, it turns out to be 2.33. So let's go ahead and just calculate it, and we'll talk about what that means. I take my V, say 24,000 pesos, that's my net position is going to be revalued, times my standard deviation, and say the standard deviation is 1 penny per peso. Then I multiply times 1.65, which is the 95% confidence interval normal distribution change in a variable. And I get a number of $396. So now what does this mean? Well, since I looked at a 1.65 standard deviation change in the variable, according to the normal distribution tables, that should only happen 5% of the time to have a 1.65% adverse change. It's a one-tailed test. So what I can say about this $396 is there's a 5% chance of this loss happening. In other words, I'm 95% confident losses will not exceed $396 from this position. So what that means, if you look at a kind of a normal bell curve, and my 95% confidence interval bar is $396, what that's saying is losses will not exceed 95 that 95% confidence interval level. My losses will be less, or there's 95% probability that losses will be less than 396, although there's a 5% chance of $396 losses or more. So let's talk about mitigating translation exposure. All right, say this firm has decided that this is not a It's not very costly to get rid of this risk, and there's not a risk, it's not immaterial for the firms. They want to do something about it. The first thing you want to probably make sure you do is let's designate the foreign currency as the functional currency. Therefore, any gains or losses will go directly to the balance sheet, never hit income and earnings. So one way of getting rid of all your earnings volatility from translation exposure or to a large extent is to specify the foreign currency as the functional, the peso as the functional. Next thing they can do, exposure netting. Say that a net long position, using the whatever method they're going to use, using the dollar as the functional or the peso as the functional. If they had a net long position, again, in this case was 24,000 pesos, one thing the firm could do is say issue $24,000 more of debt and then use that cash to pay a dividend back to the home firm. In that case, then when I do my asset or my net position, again, it would then go to zero. Or if the firm has a net payer position, they could maybe hold some more peso cash. So one thing you can do is you can manage your assets and liabilities, your receivables, payables, inventories, and cash to try to make sure that that V goes to zero. Another strategy is, if you know currencies that are likely to depreciate, which are called soft currencies, what you'd rather not have assets denominated in soft currencies. However, you would like to have assets denominated in hard currencies, ones that are likely to appreciate. Next, you could use forward contracts or option contracts to hedge the position. That's the next topic. So let's talk. So that's all translation exposure. Again, translation exposure is not cash flow changes. It may eventually be cash flow changes, but it's simply revaluing balance sheet items and then deciding where they get reported in the balance sheet or income statement. Transaction exposure is actual cash flow exposure. Now, where it gets really tricky is an accounts receivable of, say, 10 pesos. That's going to sit as a translation exposure, and say that accounts receivable sits out there for 10 years. And your accounting method says that I have to revalue all accounts receivable every period. What's going to happen is that dollar value is going to go up and down every quarter. And that's called the translation gain or loss. But it's never a cash flow gain or loss until it actually comes due. When your customer pays you your 10 pesos, and then you take those 10 pesos to your bank and you convert them into dollars. If that is different than what you're expecting, then that would be an actual cash flow loss. So how would I calculate a transaction exposure for Zapata? Well, we actually need to say, in the next few months, say, or even the next year, what accounts are actually going to turn into cash? In other words, which ones are we going to turn into US dollars? So let's say that in the next year, these 50,000 pesos receivable, you expect the customers to pay you, and then you're going to turn them into dollars. This inventory, you expect this inventory to be sold, you're going to generate pesos, and then you're going to sell them and turn it into dollars. And then lastly, let's say that your accounts payable, you forecast that those accounts are going to be turned into dollars. You're going to pay your vendors, meaning you're going to have to buy the dollars to satisfy. So say these accounts are going to come due and you need to convert them into dollars in the next year. In that case, my V, my exposure, is just the net asset liability position that's actually going to come due in, say, the next year. So let's do Zapata's IMM method measure, or risk management measure. What is Zapata's exposure? Well, we said they're long 35 million pesos, so they're exposed to a devaluation of the peso. What's their position as far as measurement? Well, they're long 35,000 pesos. That's their position. Let's do a simple stress test. What if there's a 10% devaluation of the peso? Well, take my V times the new minus old exchange rate. We already showed that new 10% devaluation is an exchange rate of 13.33. Therefore, I take my 35,000 pesos times the change in the dollar per peso exchange rate, which gives me a dollar loss of $291. Let's do our cash flow at risk. Now, when I talked about translation exposure, I said it's an EAR, earnings at risk. When we talk about transaction exposure, it's a CAR, cash flow at risk. Now, the good thing, it's the exact same formula. It's V times my Z, which is 1.65 for a 95% confidence interval CAR, and the sigma is still the annualized standard deviation. So I'll take my V, 35,000 pesos, times a 1.65 standard deviation change, and there's a 5% chance that losses could exceed $577.5, or you're 95% confident that losses will not exceed it. Now, what should we do about the risk? Well, they could decide to accept the risk because it's immaterial, it's not big enough. They could accept it because it's not hedgeable, or they accept it because it is hedgeable but it would be too costly. Or they could accept the risk because, you know what, we have peso exposure and euro exposure and pound exposure and yen exposure, and we think we're diversified across the globe. Let's pretend that Zapata is not that well diversified and this risk is not that hard to hedge. It's not too costly to hedge. It's not immaterial. So let's go ahead and decide and mitigate it. All right, what are they going to do? Again, they can do exposure netting. They can decide to make sure that they have assets and liabilities lined up so that there's no position. They could, again, make sure that those assets are hard currency assets. Now, and they could also do forwards and options. So we're going to do that in the next topic. The thing that's different that you could manage cash flow exposure on transaction exposure is just your invoices, either receivables or payables. You can negotiate a price adjustment clause that says, I will pay you, say, 10 pesos. However, if the exchange rate changes, we're going to share this risk, and we're going to adjust the price. A technical note on at-risk and time scaling. We said that the EAR or CAR is V, my value in the foreign currency, times the standard deviation, which is the dollar per FX annualized standard deviation, times my Z, which is either 1.65 or 2.33 for a 95% or a 99% confidence interval, EAR or CAR. Let's just talk a little bit about time scaling. This formula will always give you an annual EAR or CAR, an at-risk value. What if the accounts are actually due in 40 days? Well, I need to scale the standard deviation across time using the time scaling of volatility rule. And the time scaling of volatility rule says that if I have an annual standard deviation and I want a daily standard deviation, I will divide by the square root of time. Let's assume there's 260 business days in a year. If I want a daily standard deviation, I'll divide by the square root of 260, and that'll give me a daily standard deviation. If I then need a 40-day standard deviation, I can take a daily standard deviation and multiply times the square root of 40. That'll then give me a 40-day standard deviation. So, what if Zapata has this, well, let's do a new example here. Say this company has a €100 net receivable. It's coming due in 40 days, and they want a 99% confidence interval CAR. Well, 99% confidence interval means my Z is 2.33. However, we need to go from an annual standard deviation to a 40-day standard deviation. So what I'm going to do is I'm going to take my annual, divide it by the square root of days in a year. That'll give me a daily times the square root of 40. And there's one other complication I'm going to add to this, is a lot of times the standard deviation is not quoted in dollars, it is quoted in percent. So in this case, you're told that the standard deviation isn't a penny or 5 pennies or whatever. You're told that it's 10%. 10%. So to convert that to a dollar, I'll just take 10% of the direct quote. Say $1.10 is the spot price of the exchange rate. So 10% of $1.10 would be about 11 cents. So then my annualized standard deviation in dollars is 11 cents. I'll then divide that by the square root of 260, roughly the number of business days in a year, times the square root of 40, and that value is then my 40-day 99% confidence interval CAR. Lastly, the firm could decide they want to actually hedge using forward contracts. If this company had 100 million receivable due in 3 months, and all they need to do is then go out, contact some banks, and they might be told that the forward exchange rate for, say, a 3-month delivery is $1.34. They could just enter into a contract to sell 100 million euros for $1.34 in 3 months, and the risk is now gone away. They could also have it buy an option. They could buy a put option to sell 100 million euros at $1.34 3 months from now. However, if they want to, they can walk away. This will be a put option. The difference between a put option and a short forward contract to sell it is the option gives you the ability to walk away. The other difference is the option is probably going to have a cost. In this case, probably somewhere between, say, 2 and 4 cents per euro. So you'd pay 2 to 4 cents per times 100 million euros. Today, now you have the right, but not obligation, to sell your euros at $1.34 in 3 months. If the exchange rate in the market is better than $1.34 in 3 months, you'll then not exercise this option and you're just selling in the marketplace. Now, in practice, many firms do not actually hedge 100% of the receivables and payables because they're not sure if they're actually going to come through, come due. So they might hedge, say, 50 to 100% of the position, which is called either the hedge ratio or coverage ratio. So in this topic, we talked about the types of translation or exposures in FX, translation, transaction, and competitive exposure. We talked about EAR and CAR, and we talked about mitigation strategies.